Hello and welcome to this special edition of Money, Money, Money. April, the start of the new financial year. Now, you may be busy planning your summer holidays or maybe that fancy summer wedding that you're all set to attend or maybe even the next weekend break. But hold on, have you thought of planning your financial life in this new year? Fiscal 2016 has started off on a very interesting note. We're coming on the back of a year of underperformance in the equity market. Interest rates are heading south and commodities like gold and oil have been range-bound. So what does this financial environment mean for your personal wealth? How should you be prioritizing your investments, your savings, risk protection measures, and of course taxation? Well, we have a power-packed panel of experts to help you navigate through it all. Nilesh Shah, MD of Kotak Mahindra Asset Management Company, Amit Kumar Roy, Chief Distribution Officer of Aegon Life Insurance Company, Mayur Shah, who's Partner Taxation at EY, and of course financial planning expert as well as author of Yogic Wealth, Gaurav Mashruwala. Gentlemen, thank you so much for taking out the time and joining us on the show today to take all of our viewer questions. Nilesh, I'm going to start with you first because the first question that's coming to us is, okay, I'm thinking of investments. Bank FDs are not giving me anything. Equity markets have been, underperforming. I don't know if this is the top or not. What should I do? Can I make money this year? So do you think fiscal 2016-17 will be a wealth-generating year?
Yes, it will be a wealth-generating year like it was previous year and year before that and year before that. There will always be opportunities to make money provided you have patience to capture it. In FY 2016 also in the month of March, you made 12% plus return in pure equity index. Now the guy can say that, look, I remain invested all throughout and, I didn't make money. But you could have averaged always at the bottom. So to me, investment is like cricket. It's like a test match. You spend enough time on crease and then you will get your share of half volleys which you can hit out of the stadium. Don't try to hit every ball for a six.
Okay, fair enough. So slow and steady, I get that point. But exactly what you said. At times, you end up looking at your equity investments and you think long-term because most experts say that you should be in this market for the long term and not for short-term trading gains. But you end up also missing cycles if you haven't exited your investment at the right time or churned your portfolio at the right time. Then you end up wondering what happened because I've come back to either ground zero. In some cases, I've gone below ground zero all over again. So how to look at portfolio management then?
So the rule of the game remains the same whether you are creating financial wealth or physical wealth. In physical health, we do SIP in our food. So our food basket is like a thali. Some vegetables, some dal, some chawal, some roti. Create same on your financial side. Some equity, some debt, some commodity, some currency, some real estate. Typically for your physical health, you take medicines in SIP basis. You don't take all 3-day or 7 days courses of medicine at one go so that you are cured easily. You take it on a, after lunch, before dinner and so on and so forth. Do same thing in your investment side. So the way you have maintained your physical health, which all of us are capable of doing, the principle remains the same on financial health. There is no difference.
So I'm going to come back to you and figure out how this well-balanced financial thali needs to be created. I'm going to come back on that point in just a bit. But Amit, let me get your thoughts in as well. And you represent the insurance sector, of course, life insurance in particular. But what can insurance buyers look forward to in 2015-16? Will premiums keep rising? We're seeing that in health insurance. Will life insurance term premiums keep rising? Can we expect more products? Can we expect simpler products which people can actually invest in?
Yeah, I think you broke into 3 different categories of question. One is around what the customer can expect in terms of getting the product in what form. So there I see a huge opportunity of getting into digital kind of a market. Where it will be easy simpler for the customer to perceive the product and probably for the first time purchasing life insurance for the sake of protection, life insurance for life insurance. If they would look for return, obviously Nilesh Bhai being there, that kind of setup should be there. I think many a times people get confused. So what people
they buy insurance thinking, okay, I'm buying protection, might as well look at wealth generation.
So this is my typical example in this kind of a situation is that when you want a detergent, purchase the detergent, don't get into that. additional bucket that you are getting. So I think we should remember that. Another very important trend that I see is that actually the value proposition for the customer will go up. Unlike to what the premium going up or down, I would rather say that every company, and also the regulator is helping us to do that, is coming up with much more simpler product, more towards customer value proposition.
So when you say value proposition for the customer should go up this year, demystify that. What does that mean? In what way can consumers and insurance buyers hope to get more value from companies?
First of all, I would say that at least they would get to understand what they are buying.
That would be a great start. It would be a great start, yes.
I think the second thing that we can definitely expect is that the so-called, the returns on life insurance, investment will be much more transparent with everything, getting into a plate now for the regulated regime. Now every company is bound to do this, that customer will get to know out of every 100 rupee how much you are paying for investment, how much you are paying for your mortality charges, which is insurance coverage. More importantly, I think what they will get in is a lot of varieties in terms of health protection, in terms of pension, in terms of probably necessary things like building a house. If you are not able to manage everything out of very, very differentiated product, will put in the money where the fund manager will get into some kind of investment with equity linked things and a couple of things like that. I think the value proposition in the entire plate would be more for the customer in terms of getting everything to understand better with simpler message.
Okay, fine. Gaurav, what do you think? Is this going to be a wealth creating year, or will it be a little more subdued one like the last fiscal that closed
I wish I could predict and make a lot of money and I wouldn't be sitting here, but winners rotate. And to that extent, if you're going to chase past winners, you're bound to be in trouble. And this happens because people don't have clarity on to why they are saving or why they are investing, because goals are not decided. The moment that's done, your life is easier, because then it doesn't matter which asset class goes up or down. Because, for example, if you require money in 6 to 8 months time or a year's time, you should not be into equity market, either directly or through an equity mutual fund. If you require money after 7, 8, 9 years, you should not be into a debt-based instrument. So the moment you start aligning your investments to your condition, you will create wealth. If you keep aligning your investments to economic condition and chase past winners, you're bound to be in difficulty. So it's a call that you need to take. I mean, the moment you have thought clarity and you know where you want to go, you know the destination, you know the vehicle, you're fine.
Okay, fair enough. Mayur, from the taxation standpoint, we've already gone through the fine print of the budget this year, and a couple of big announcements came. There is a tax on dividends, those who are earning huge amounts of dividend, etc. Small tinkering in, the rebate, additional rebate that investors or rather taxpayers can enjoy. But overall, from a taxation standpoint, is this year going to leave us richer or poorer or at baseline?
My belief is that, as far as those who are earning a good amount of income, will have to pay more than what they were paying last year.
Okay.
As far as the average persons are concerned, I think they should remain unaffected, because there is nothing much to offer to them. I think what was there is just being there, and nothing new which has been put in place, except few things like the people who are self-employed and have to pay rental. Instead of now 24,000, they can claim deduction up to 60,000. It's not a big relief, but certainly it's a relief. So this is what I see, that I don't think they will be left with more money to invest or build wealth around, but certainly those people who are earning higher income would have to shell out more. And
you say that because of, I'm guessing, the dividend tax, and what are the other areas that concern you?
Dividend tax is there. Also, the surcharge has been increased from 12% to 15%.
Yeah.
So that is where, the maximum marginal rate has gone up to 35%.
Sure. Absolutely. So, Nilesh, now coming back to the thali that we're trying to create here, which is a well-balanced thali for financial health. If you're looking at this year, and primarily your equity basket for this year, then how should it be balanced out between how much money in... And I'm talking about here, taking the example of a medium risk investor. for the purposes of clarity. So how much should be in large cap funds? Should you look at, generating more alpha, as they say in market parlance? Should you be thinking of, sector-specific funds? And also, will we get a lot of NFOs this year, or is this going to be the year of streamlining and consolidating existing funds?
My guess is that on the NFO side, we are not likely to see many more NFOs. If at all, SEBI is focused on consolidating existing schemes so that it becomes easier for investors to figure out which fund to invest into. The second thing, in terms of equity investment, your investment should be driven by two factors. One is the asset allocation, how much risk appetite you have and how much you want to invest into equity. And second, regular investment. I mean, most of us earn income on a regular basis rather than, once in a year. And we should try to invest every month something. Warren Buffett made a nice statement that income minus expenditure is savings, but actually it should be income minus savings, which should be expenditure. So you need to invest on a regular basis, and from a market point of view, whether you invest in large cap, multi cap, mid cap, that should be more function of your risk profile. For an average investor who is not really willing to take too much of a risk, I think he should be just focused on large cap and multi cap, which has a blend of large and mid cap exposure, rather than going into sector funds.
So before we end this part of our conversation, your thoughts on your reading of the market and where you think the opportunities lie for this year, because a lot of talk is there. I mean, we've seen cement stocks do really well. Some people are talking about the possibility of actual green shoots in the cyclical side of the market as well. Do you believe that? Where do you think money will be made this year?
So why focus only on this year? Because if I'm going to last for an whole inning, whether I scored in first over or second over or fifth over doesn't matter. Let's look at what opportunity we have. Most pessimistic analyst on India today is talking about the fact that we'll double our GDP over next 15 years. The most optimistic guy is talking about 8 to 10 years. Now, will probably surprise both optimistic as well as pessimistic. So maybe somewhere between next 10 to 15 years, we'll double our GDP, which is $2 trillion today, to about $4 trillion plus. That $2 trillion GDP creation is more than what we have created till today, or almost equivalent to what we have created till today. Now, over the last 25 years, we have created so many wealth-creating opportunities in equity market. You see these stocks in banks, autos, FMCGs, pharma, cement, you name the sector, IT, and there has been tremendous wealth-creating opportunities. Now, what we have created over the last 15, 20, 30 years is going to get replicated in next 10 or 15 years. It is up to us to capture that opportunity.
Okay. So be in it for the long term.
Absolutely.
There's no point checking your NAV and your fund values every other month or every quarter. Okay, fair enough. Well, we'll take a quick break. On the other side, the other phenomena that's going to be a hallmark feature of this year, interest rates are falling. Is it all good news? Is it bad news for your debt investments? Where should you be parking your money if you want a little bit of the safety that debt is supposed to offer? All that after the break.